Hey, Steve Saretsky here. As always, there's going to be a couple blog posts that go with this, so you can check those out in the description below. If you haven't already, hit subscribe, thumbs up, whatever, comment below. Just try to get the engagement going here. So obviously any support, always appreciate that. But basically just wanted to talk about a few things, looking through some of the latest data that came out from CMHC. As house prices have increased, exponentially over the last couple of years, in a Vancouver detached house, you were seeing price growth of, 25-30% year over year. And then that really started to spread out into, the Fraser Valley and places located, let's give like Abbotsford Mission, where, historically there hasn't really been much. If you actually look at it, again, you can put the data with this, but there really was never really that much price appreciation, even in the detached market for these. If you're lucky, a couple percent a year, which is sort of rising with inflation. And then all of a sudden, Mission detached prices increased. I believe it was 40%, 40 year over year. So you had this massive price acceleration, right? And so what you have is you have people that then begin to, it creates a wealth effect. Obviously, you bought in at 500, now you're worth 700. You naturally feel wealthier. You then spend into the economy. This is what's called essentially the wealth effect. And so you have people that then begin to tap into their home equity, spending on various things. I'm going to get into that in a second, but I basically just want to touch on the numbers first of all. So basically CMHC released what is called their refinancing numbers, and they quantify, now understand this, they quantify refinancing as that an existing person that owned and had a mortgage, so regardless of the interest rate, they had a mortgage. In order for it to be considered a refinance, their actual mortgage balance outstanding had to increase by 10% or more. So people refinance. There's various reasons for it. Obviously you can take advantage of a lower interest rate. You can take that, draw out some equity, and you can funnel that equity into down payment on, say, an investment condo, or you can take that to pay off existing debts, or you can use it for home renos or buy a new car, new boat, etc. You can do whatever you so please with it, but you basically restructure it, you refinance it. You can push the amortization down. Let's say you a couple of years ago you had a 25-year amortization, you signed on, now you're down to 23. Well, you can essentially scale it. You can draw equity out and push it to a 30-year amortization, or something along those lines. Draw some money, some equity that you've made out of your home, and really spend it into the economy. And this is part of the reasons why governments love inflated asset prices, such as housing. There was multiple quotes from famed economists back in, I believe it was in 2002, after the stock market crashed, that I think it was Larry Summers, the Fed, the Alan Greenspan's got to inflate a housing bubble to get this economy going. And of course we all know how that played out. They essentially came out with all these various home programs, encouraged people to get into housing. Homeownership rate went up in the States, bad lending. Obviously created a massive wealth effect. And so it's interesting because the number on that, so there's a very, very good book. I've mentioned it in many videos here. It's called The House of Debt. It's basically two prize economists. They got multiple awards in this book. It was recommended as the top economic book in 2015. But essentially, they did a huge study on basically booms and busts. Particularly, it was a huge focus on real estate and the effects of creating this wealth effect and people's, when their home equity goes up. But basically what they found was for every dollar, and this is in the United States, so you have to imagine that Canadians are probably fairly similar. So in the States, for every dollar of equity, of every dollar in value your home went up, that on average Americans spent 40 cents. Okay, they borrowed 40 cents. So every dollar you went up, so obviously if your house went up $100,000 on average, they took out $40,000 and spent that. And what they found was that they actually didn't pay down existing debts. The majority of these people actually they went and bought boats, Fords, brand new cars, family vacations, And they spent this again, so 40 cents on the dollar for every increase. So you can imagine, okay, now we bring this into Canada. I would imagine people here act fairly similar. So you have to ask, okay, well, we've had massive price acceleration. Again, like I said, Mission 40% year over year, and this is an area that is these people aren't necessarily used to all of a sudden massive price acceleration in Abbotsford Mission. So you've had this, and so the refinancing numbers, the mortgage balances outstanding in Vancouver increased 27% year over year, and in Abbotsford Mission increased, I believe it was 49% year over year. So okay, let's put this into context. People refinancing their home, that's drawing equity out, whether they are using it responsibly to pay debt, or they're using it maybe a little less irresponsibly to buy a boat or a car. There's no question. So the 27% of people, there was a 27% increase in consumers refinancing their home year over year, and then in Abbotsford Mission, it's 49%. Which is just it's an astonishing number. So that basically just tells me, how many people are drawing equity out of their homes. And, this isn't about these videos about predicting the markets. It's really about education and understanding what is happening in the market. What are people doing? And then you formulate your own opinions on, is this a good thing? Is this a bad thing? What does this mean, for me? For me, it just tells me that this has created a massive wealth effect. Again, this is why governments are reluctant to, as much as they want to talk about crushing housing bubbles or whatever, this is why they need to keep asset prices inflated. It's because house prices generally make people feel wealthier. We have a 70% homeownership rate in Canada. I believe it's one of the highest in the world. And so, as much as people want affordability, you got 70% of the nation that's invested into real estate. And so if you crush those prices, not only are you going to slash consumer spending, you're instantly going to put the economy in a recession. Again, refinancing 49%, Vancouver 27%. These people are drawing out equity, and if they're even remotely similar to their American counterparts, our neighbors, the fact of the matter is they're probably spending that on stuff that isn't worth anything, that's devaluing, whether it's a truck, a boat, a vacation, they're spending it, but ultimately so your home essentially becomes an ATM, right? I mean, you're not earning any money in the bank because it's all about inflating these asset prices. It's basically like the new ATM, and it keeps working and working and working and going as long as house prices continue to rise. So it's like that reverse. You can't start pulling equity out of your home if house prices are coming down, right? So it's all fine and dandy as long as house prices go up. Now you have to look at it and say, okay, what if house prices do come down, and you have all these people that are basically pulled out of equity out of their home that they think they have, but it can easily be taken away, in a market correction. So and that's where people ultimately get jammed up, right? Is just because your house has gone up 100,000 doesn't mean it's going to be there in a year or 2 years, right? Like markets have been cyclical, and this is not to say where the market's going to go or how much it's going to correct. Again, it's just understanding what's going on. You go back into financial history, you can just look at other areas and how this always happens where home prices go up, creates that wealth effect, people spend, and ultimately a lot of people just don't. The reality of it is they don't spend responsibly, and and then when prices correct, all of a sudden they have to really tighten up because that equity that they thought they felt rich isn't actually equity until you cash out. So I mean it's interesting, having myself, family members that are actually in the debt consolidation business that deal with people on a consistent day in day out basis. People that have maxed out credit cards, lines of credit, hearing these stories, and just telling them, maybe this is why your business is so slow, because basically people are just able to continue to refinance and service existing debts, right? Like if you got, I don't know, 50,000 on a credit card, you got a couple lines of credit, etc. You just basically just keep refinancing your home, and you just pay off those existing debts, and it's all good because house prices continue to rise. And that stops if house prices stop again. So it's just understanding what the game that is being played here today, and why governments are so reluctant. Central banks, there's no question. Central banks have come out since 2012 warning that Canada, it was Mark Carney or one of his guys there at the Bank of Canada said, you're gonna create a housing bubble. We need to raise interest rates. We need to raise them, but they kept the status quo, and these guys just don't really think ahead, right? Nobody really thinks ahead about the potential consequences. Obviously, you have Canadian private household debt, which is, many economists have argued is the most impactful on the economy. That it is the highest. Canadian household debt is the highest in the G7. I mean, it's historical, the credit growth that we've seen, and again, it's all predicated on house prices. So it's very interesting to watch. It's just my analytical thought process behind it. Obviously you worry for people if there is a housing downturn. I don't know, is it going to happen? I don't know. I think real estate is always cyclical. Maybe this is a message to people that are drawing out equity to understand some of the pros and the cons involved of it. Again, I think it's a very, very useful tool to be used if you can capitalize on a lower interest rate and pay off existing debts. But if you're going out and spending that and thinking the money there, again, you don't have that real equity. It's just paper money until you actually cash out. But just to see some of the behavior, in this book, The House of Debt, again, they talk about sort of the outlying areas. It's more of the suburbs that sort of get caught up in this because, these prices tend to really accelerate as it remains, people get priced out of certain areas. So you take Vancouver, an example, if you get priced out of Vancouver, where do you go next, right? You go maybe Burnaby. As you get priced out of Burnaby, you go to Surrey. And those tend to be like lower income areas. You go to Abbotsford Mission. People go out there for affordability. They go out there to buy the $500,000-$600,000 detached house, as opposed to say a one-bedroom condo in Vancouver. So it tends to be sort of like an area where you go for affordability. People buy in. They're not really expecting the massive price increases that you'd see in a Vancouver detached house, but it's a big yard. And then all of a sudden you have run-up prices of 30-40% a year, and people are like, oh my gosh, like I'm rich. Draw the equity out, spend it. Interesting. So anyways, love to hear your comments, thoughts, perspectives. There's a link to that below. What else I got for you? Quick touch on maybe the Vancouver condo market. As always, a little bit of a cool down, if you can even call it that. I mean, it's actually funny to say this. Condo, the number of multiple offers for Vancouver West condos, which is the main primary. Most of the sales are on the Vancouver West side for condos. Number of sales over asking price in July was 49%, down from 53. So it's starting to hit that downtrend. The sales to active ratio has dropped off quite a bit. August tends to be a slower month. It's sort of a seasonal thing. I'm not sure if this is more of a downward swing, but it's a little bit of a cool down. But again, obviously 49%. So basically, if you're looking for a 1-bedroom, 2-bedroom, even a 3-bedroom, those are very rare. You basically have to be expecting to be competing in multiple offers. So that's what's going on. Again, I mean, you can look at condos again, where we're still seeing price acceleration in Vancouver. It's been almost 2% increases every single month. So it's like even people that bought in 2016 that are up, 20% year over year, can just start pulling equity out of that, right? But interesting to say the least. And that's all I got for you. And we'll see you soon.